Episode 4. I realize that the number 4 may not be the luckiest for some people, but I happen to like the number 4. Why? Because it's so central to academics and sports. So I actually tried to get into medical school after 3 years of undergrad, but I bombed verbal reasoning twice, and then UBC still somehow let my ass in the door. 4 years of medical school after that. There are four major tournaments in tennis and in golf. Tiger Woods has four PGA championships. Mario Lemieux and Sidney Crosby, between them, have four Conn Smythe trophies. Okay, I realize this conversation is way more sports oriented than academics, but, anyways, LeBron James has four NBA championships and four NBA Finals MVPs. Is he the best ever? Is he the best ever? I don't know, it's up for debate. I have 4 years of medical practice under my belt, which is around the time they say that your knowledge base peaks, and then it's all downhill from there. So, with that in mind, episode 4 Mortgages, here we go. Welcome, everyone, to the fourth episode of the Beyond MD podcast. Everyone these days seems to be talking about mortgages. What kind of rate can I get? So I thought that this would be the right time for an episode. Today's interview is with Elan Weintraub, who is a mortgage specialist and co-founder of the Mortgage Outlet, a brokerage here in Toronto. So a quick personal story. We bought our home in Thornhill in the spring of 2019. And unexpectedly, we ran into some issues with getting financing and the home appraisal done on time. At that point, I was introduced to Elan. He came in, took care of everything, very efficient, and got the job done. So I know firsthand that the Mortgage Outlet, Elan and his team, they will grind to get the job done for you. Before the interview, let's just lay down some fundamentals. So first thing, the anatomy of a mortgage. So how are these things structured? So in the earlier years of your mortgage, your payments are going to be much heavier on interest, and in the later years, your payments are going to be much heavier on principal and less so on interest. That's just how they're structured. Now, how much interest do you end up paying? So let's take an example. Purchase price 1.25 million, you pay 20% down, the mortgage is 1 million. And I'll be nice here. Let's just say you lock in one of these kick-ass interest rates, 5 years fixed, 1.65%, and let's keep that interest rate constant for the 25-year amortization. Come on, you and I both know that is not going to happen. But for this example, let's do it. Year one, $16,500 of interest. Over the lifetime of the mortgage, you're going to pay $220,000 of interest. Let's go to a larger mortgage, $1.5 million. Let's get real with these interest rates. I'll bump them up a little bit to an average of 2% over the amortization. Your interest payments are going to be over $400,000. What's the point I'm trying to make here? Even at these low rates, these mortgages are not free money. But that being said, I'm not telling you that the best way to use your money is to pay down your mortgage faster. Let's take the $400,000 from the last example, and instead of paying down the mortgage faster, let's put that money into the markets through ETFs. Even in a moderate risk portfolio, you're hoping for around 6% return per year, so you could potentially double your money in 12 years, 400,000 to 800K. But the point I'm trying to make is that even at these low rates, mortgages are not free money. You will be paying a lot of interest. So for people who have a desire to pay them down faster, what can you do? You can shorten down your amortization, or you can look into prepayment options. Talk to your lender about that. So right now, everyone seems fixated on the fixed rate mortgage, and for good reason, because these rates are at historical lows. But it's nice to take a second and understand the different forces that affect the fixed mortgage rate. And it turns out that it is heavily influenced by bond yields. So I don't want to get too technical here because I'm a simple guy with simple needs, but let's just take a second to understand this. So COVID-19 hits, investors start shitting their pants, and then the Bank of Canada starts buying unprecedented levels of Canadian government bonds. All this bond buying activity drives bond prices up, which drives bond yields down. And when bond yields go down, that inevitably results in a fall in the fixed mortgage rate. There is a very good correlation. Oh my God, you and I never thought bonds were this cool. But they are, because prices in the government bond market dictate prices in the credit market. What's happening now? This trend is starting to reverse a little bit. Okay, bond buying activity is probably not at the same level, and we have a lot of positive news regarding a potential vaccine. So just recently, the bond yields started to go up, and that's leading some people to say that fixed rate mortgages could go up as well. So if you're looking to lock one in, now may be a great time. Why do people like fixed rate mortgages? Well, it's clearly because it's stable, it's predictable. You know how much you're going to be paying each month. The negative with the fixed rates is that you can get dinged if your life changes and you need to move, break your mortgage. Trust me, this is not fun. We have gone through this exact scenario, not a high point in my life. Now, the variable rate mortgage, in contrast, is going to directly follow the prime rate. So the prime rate right now is 2.45%. So prime minus 1 or prime minus 1.1 lands you in excellent territory. Sometimes people shy away from variable rate mortgages because it can result in a fluctuation in your monthly payments if the prime rate changes. But what some lenders have started to do now is they've started to offer fixed payment options when you're on a variable rate mortgage. Well, how does that work? So let's say if the prime rate goes up, well, then your monthly payment's going to stay the same, but then more of the payment will be going towards interest. And if the prime rate goes down, then more of your payment will be going towards the principal. So there are certain features within these variable rate mortgages, including having the ability to convert to a fixed rate. Now, that doesn't always mean you land the best fixed rate possible. We'll talk a little bit more about this in the interview. So, moving on to amortization, all you really need to know is that if your amortization increases, well, then you're overall going to be paying more interest on your home. And then finally, let's just talk about the HELOC. What the hell is a HELOC? It's a home equity line of credit. Basically, when you're paying down your house, when you're paying your mortgage, you're building equity in your home. And then you can take some of that out again in the form of a home equity line of credit. Well, how much can you take out? The calculation is pretty simple. It's basically 80% of your home value minus the remaining balance on your mortgage. That's how much you can take out, but that final number typically has to be less than 65% of your total home value. Now, lenders do have various spins on the HELOC, and we will touch on some of these details later on. So, for today's interview, we are very lucky to have Elan Weintraub, who is the co founder and director at the Mortgage Outlet, which is one of the largest independent mortgage brokerages in Canada. The Mortgage Outlet is frequently featured in the media. You've probably heard about it in the Globe and Mail, and it's also received numerous industry awards, including Mortgage Brokerage of the Year. Elon is very proud of the reputation and culture that he and his partner, Sean Stillman, have built, and their practice pillars are based on excellence, personal and professional growth, cooperation, intense training, and fun. So it sounds like these guys know how to work hard, which I already know they do, but it sounds like they can play hard as well. Listen, I think the pandemic has all worn us down at different points, and this may be a bit preemptive, but I think some of us are probably getting to the stage where we're beginning to make a short list of people who we would like to have join us for when the pandemic is finally over, we have our vaccinations, and we finally hit the city on that big night out, drinks galore. Like, who would you want to have join you? I mean, I'd want to have people who I would have a good time with, of course, but then the pandemic has changed us and shaped us in different ways. I would want to have people who would be interesting to talk to, personable, and people who I could learn from. And I think Elon is the type of guy who cracks a list like that. So I think you're really going to enjoy the interview with him. He is a straight talker, no nonsense, no bullshit, all facts. Here's the interview. Elon, thanks for joining us. Where does this podcast find you?
I'm in my dining room.
All right, short and sweet. So, Elon, I'm really excited about this topic because I think everyone's talking about mortgages. It's top of mind. But before we get into it, I just want to get your input on what's been happening during the pandemic. There just seems to be this drive to get the hell out of the city. I mean, I understand the logic behind these decisions, but the pace at which this has happened has been totally mind-boggling. So, just would like your take on it.
Yeah, I think there's a couple of factors at play. I think, people can work remotely now. So you might have a husband and wife. They're not going to the office. So they might be in a 700 square foot condo. They're both working from home on Zoom meetings. There simply isn't enough room. Maybe they have kids. They can't go out to the park as easily. So they just want to move out into the city. They want one or two home offices. They want a backyard. And frankly, a lot of the amenities that they had in their condo, whether it's a swimming pool or the local restaurant, they can't really use.
All right, so before we dive into mortgage rates and where these rates are going, I'd like to just ask you about your role as a broker, and perhaps you can just elaborate on the services that you guys offer,
Mhm.
because I can tell you that up until 2 years ago, I wasn't really clear on what mortgage brokers do, and perhaps touch on some of the advantages you can offer a new home buyer who's looking to get the best interest rate possible,
Sure.
what can you guys do to help set these people up for success?
Oh, that's a great question. I'm going to use an analogy to explain, but when you walk into your local bank, your branch, it's like walking into a BMW dealership. And you're going to get a really good car. You're going to, probably be pretty happy. But the BMW dealer is not going to tell you that Audi is on sale this week. And they're not going to tell you that there's this cool thing called Tesla and you should check it out. And they're not going to tell you, oh, by the way, you have 6 kids. You might actually want a minivan, and we don't really make BMW minivans. So the way that I describe a mortgage broker is, a good mortgage broker will understand your current and future financial needs
Uh-huh.
and will give you options, and then you'll go with those options. The other thing that I would add is a lot of times in the bank, the person is selling RSPs and checking accounts and all these wonderful things. Whereas, I kind of joke and, I think about mortgages 24/7.
Hmm.
So, that's my specialty. That's what I do. And, that's some of the advantages that a mortgage broker can bring. And also with a mortgage broker, we send TD Bank, about $100 million of business every year.
Yep.
When you walk in, you're, a single person. So we're probably going to have more pull, better rates, more exceptions, all of that good stuff.
Awesome. And I know how hard you guys grind. So, in my mind, that's another advantage that you can offer. So let's pivot now to mortgage rates and maybe try and understand how these things move. And I just want to make reference to the start of the pandemic, the crisis in March. There were some interesting articles put out in the Globe and Mail and the Toronto Star that were talking about how fixed rate mortgages were ironically increasing when the pandemic was starting while variable rates were going down. And just trying to make sense of this, I guess at the start of a pandemic, everybody, all investors are scared. So there's a sell off of everything. And to get investors back into the market, even for mortgages, they need to be offered a pretty high interest rate. And so the banks have to turn a profit somewhere. So therefore, the fixed rates, in fact, go up. But since then, obviously, the fixed rates have been coming down. So, Elon, maybe you can just guide us through the different forces that affect mortgage rates. Talk us through this a little bit.
Well, I think the way that I describe it is a lot of people are confused when the Bank of Canada adjusts the prime rate. Maybe the rates go down, maybe the rates go up. The fixed rates don't always mirror that.
Right.
And the reason why is your variable rate mortgages and some of your credit cards and lines of credit are directly tied to the prime rate of Canada. And if the prime rate goes down, the variable rate goes down pretty much. Fixed rates are actually based on the bond market, which is based on the supply and demand of money and based on fears and predictions and all these wonderful things. So, but earlier in the year, like Jan Feb, I would say rates were, call it 299, maybe a bit higher. And obviously March came in, April, May, and the Bank of Canada just massively started buying bonds and really forcing rates to go down pretty much to the lowest rates in the past 100 years plus.
Okay, let's maybe elaborate a bit more on these bond yields. Specifically, let's talk about how strong is a correlation between the bond yields and the fixed rates,
Yeah,
and what is the delta, the difference that you can expect between the bond yields and your current fixed rates?
well, it's very strongly correlated. You know, Generally the whatever the bond rate is, the banks want between 1 to 1.5% kind of profit or yield on top of it. So right now, the rates are around 0.46.
Okay.
And if you add, 1.5%, that's about 196. So
Hmm.
that's a little bit on the high side, but you can get rates a little bit lower. But earlier in the year, I mean, rates were the bond rates were around 1.5, give or take.
Okay, so now that we understand this, I'm not going to ask you to wave your magic wand and tell us what's going to happen, but I really would like your insight into where you think interest rates and mortgage rates go from here.
Yeah, I mean, my your crystal ball is as good as mine. I was thinking more that rates would go up. There's a lot of factors at play. If there's a vaccine, how quickly it's deployed, all these wonderful things.
Hmm.
Part of the way that I look at it is real estate is really holding up a big part of the Canadian economy. And I almost describe it like a drug where even if the government wants to start raising rates to 3% and 4% and 5%, that will really hurt consumers. It will hurt voters. And even if they want to start raising it, they can't
Yeah.
because it will really hurt everyone. So, the government is in a tough spot. I don't think rates are going anywhere for, I'll say on the variable side, at least six to 12 months, maybe longer.
Okay.
And, CMHC has kind of made that prediction. A lot of economists have made that prediction.
Yeah, I agree with you in that the government is in a really tough spot. And if rates are hiked too quickly, I mean, we would be on the precipice of total chaos. You would have homeowners and investors in general just jumping off a cliff. It would be brutal. So, whatever is done, whatever changes are made, I think need to be done gradually and delicately. So, right now, a lot of people are attracted to the low fixed rate mortgages, and rightly so. They are historically low. And if you lock it in for 5 years, great deal. But sometimes I feel like the variable rate may not get enough attention. And I'll tell you why. So I've talked to several people I know who have been buying real estate for years and decades. They've had several mortgages, and they tell me they always go variable. And I asked them why. And they said, listen, with variable, you're inevitably going to enjoy some dips in the interest rate. Interest rates just tend to be lower now than they used to be decades ago, and you don't have to worry about timing things. Whereas with the fixed rate mortgage, you may try to lock something in, but then rates could fall lower.
Yeah.
So there's an element of timing there. So my question is, over the long haul, would one generally save if they consistently went variable rate on, let's say, a 25-year amortization? What's your take on this?
So I've read studies that say the statistics show that variable is the way to go. But here's how I work with my clients to help them make the decision. So first of all, I want to understand the life stage of the clients and just sort of psychographically who they are. So I'm going to contrast, University of Waterloo or U of T computer engineering grad, maybe they're single, buying their first condo. Well, they might get married, they might move to Silicon Valley. There's a lot of, opportunity. There's a lot going on compared to maybe like a 35-year-old married couple, both in very stable jobs. Their kids go to school, 3 minutes away, probably not moving anywhere.
Yeah.
And then psychographically, are you the type of person that every time there's a Bank of Canada announcement, you're going to be biting your nails because you're like so concerned about the stress?
Hmm.
So this is like, kind of a practical, an emotional decision as well as a logical one.
Hmm.
But the other, probably most important thing, and the reason why a lot of people would argue that variable is the way to go, is because the penalties on fixed rates can be punitive.
Yeah.
Generally, the fixed rate or the penalties on variable rates are 3 months of interest. So
Uh-huh.
I had a client, he has $1 million mortgage, 2.99%. And I was doing math because right now I could get him, 1.79, 1.69. So he's saving a lot of money. The penalty was $52,000.
Wow.
It was almost exactly a 5% penalty. Variable is 3 months of interest.
Yeah.
So again, if I contrast, you're very stable, you're not going to refinance, you're not going to buy a cottage, you're not going to invest your money. Fixed rates, I mean, right now you're getting fixed rates at under 2%. That's fantastic.
Yeah.
But if you've got more uncertainty, if you're an investor, you might want to pull money out, variable might be the way to go.
Okay, let's take these variable rates a little bit further because I find them more interesting than the fixed rate. They're obviously more complex.
Yeah.
And I want to touch on some potential features that might be available with a variable rate mortgage, such as being able to convert to fixed and then having an interest rate cap. So let's say I'm a new homeowner and I decide to go variable. And then let's just say after a few quarters, the prime rate begins to rise.
Mm-hmm.
Can I, in that moment, say, oh my God, let me contact my broker? Can you please lock me in at the lowest fixed rate available? Or is the lender going to lock me in at something higher?
Yeah.
And then the second part, I guess, regarding caps, interest rate caps, is that something that's automatically available with most variable rate mortgages? Or is this something that you have to negotiate? Can you talk us through these features maybe?
Yeah. So there's a couple things there, and let me answer that question first. But the way I would describe it is, let's say you get a variable rate now, and then 9 months from now you want to convert to fixed rates.
Hmm.
So one, the analogy I use is that the train has already started to leave the station. So by the time you're starting to think about converting to fixed, probably those bond yields have started going up, and you're not going to lock in at the bottom.
Yeah.
The other thing is, frankly speaking, and I'll say this of every bank, every credit union, every insurance company that I deal with, banks are amazing, and then they're also terrible at the same time. So if you're in the middle of a mortgage,
Hmm.
they have you under some form of a contract.
Right.
They're not going to be as eager to give you the best rates possible. They're not going to give you the 5% posted rates, but they're certainly not going to give you like the low, promotional rates to get you in the door.
All right, that's good to know. So basically, don't expect to start off at variable 1.35 and then 9 months later, if rates rise, try to lock in 1.6, 1.7.
And one other thing. There are this is there again very very lender specific. There are some lenders that will cap the variable rate,
Yep.
and there are other lenders that I'll use TD for as an example. It's somewhat unique, but let's say your payment is $4,000 a month.
Okay.
Variable rates start to rise. TD is actually, I think this is a pretty cool feature. Your payment basically will stay fixed at 4,000 a month. Background, your amortization is changing because the prime rate is increasing.
Right.
So, people care about their cash flow. So they want to know it's 4,000 a month, 4,000 a month, 2,000 a month, whatever it is. They're concerned about cash flow. So with TD's variable rate and a few other lenders, largely the payment stays the same, even in a rising or declining rate environment.
Yeah, that's really interesting, Elon. I mean, that's a policy that I really wasn't familiar with until recently, but I can see the appeal. So for people who are wanting to take a shot with the variable rate, just knowing that you can have some predictability month to month in terms of your payments and have control of that cash flow, for sure, very appealing. Now, when a home buyer is looking into a mortgage, obviously locking in the best rate, that's kind of top of mind, and I can see why. You're obviously going to be saving on a lot of interest over time, hopefully.
Yeah,
But one thing I did want to clarify is I have heard that for some home buyers who are actually going to be paying down less than 20% for down payment and then buying some mortgage insurance on the side, I've heard that those home buyers can actually lock in a lower rate than somebody who's willing or able to put down at least 20%. I just wanted to clarify this. Is this at
sure.
all true?
Yeah, it's 100% true. It doesn't make sense kind of on the surface, but behind the scenes it actually does make sense. So very simply, if you ask me what my best rates are, so first of all, I'm going to use another analogy. It's kind of like, well, how much is a car? You could buy a BMW 3 Series and a 7 Series. So it's not even enough to say, well, how much is a BMW? It really depends on the specifics of the mortgage. Now, my best rates are always high ratio. So right now, I think I have 1.50% for 5 years fixed,
Uh-huh.
which is pretty crazy. Um, Now, the reason that the lenders can offer that rate is because the borrower is basically buying a 5, 10, 15, $20,000 insurance policy that they're paying for to protect the lender.
Yeah.
So in other words, it's like, I'll give you, Royal Bank, TD Bank, whatever it is, a $20,000 insurance policy, and then in token, they recognize that and they give you a slightly better rate.
Okay.
But you're paying a $20,000, $10,000 insurance policy. So, the simple answer, and I've actually had people ask me, is it better to just, get that 1.5% rate? And the answer is no. If you have 20% down, you never want to buy insurance for the bank,
Hmm.
because that little bit of savings on interest, you're paying $10,000 upfront today,
Right.
doesn't make sense. But the lowest rates are always high ratio, 5% down, 10% down.
Okay, so a little counterintuitive on the surface, as you say, but basically what I'm getting here is you pay less than 20% down. You may save a few basis points here or there on the interest rate, but that's not going to offset the cost for mortgage insurance.
Like 99% of the time, yeah.
All right, so we've touched on the importance of optimizing the interest rate in a mortgage. And now I'd kind of want to shift gears a little bit, looking at various payment acceleration techniques for people who are interested in maybe paying down their mortgage a little bit faster. So
Sure.
I can tell you in the last week, I spent some time just making love to some spreadsheets. I looked at different prepayment options, whether it was regular annual, quarterly, or more infrequent but larger lump sum prepayments to pay down that principal to see how much interest I could save in my mortgage. And I just like to touch on this for people who are interested.
Sure. The first one is payment frequency. And generally, I suggest that clients match up how they're paid with their mortgage payment frequency. So, for example, if I have a husband and wife and they're paid on alternate weeks, they can actually mathematically pay their mortgage down faster by paying their mortgage weekly. But the benefit of that is it also matches their cash flow. So, money in, money out, money in, money out, and you're paying your mortgage down faster. Then, of course, you can make lump sum payments. Some lenders are very, very stingy in how they let you do this. They might only let you do it once per year,
Yep.
which is really not ideal for the consumer. Other ones and might only let you do 10%. Other ones might let you do 20%, and it could be quarterly, monthly, depending on how often you want to do it. So it depends on your income. If you get a $20,000 bonus, that could be a good opportunity to do a lump sum.
Yep.
Or if you get a raise and you might decide to just kind of increase your weekly or biweekly or monthly payment based on that, and all that extra money that you're paying is going directly to reduce the amount you owe. Now, one thing that's kind of interesting is, rates are so low right now that there's actually this paradox that it's, or catch 22, that it's not worth paying down your debt, because if your rate is, 1.79%,
Yep.
that's basically inflation. You could probably and hopefully use your money to invest or pay down other debt or RSPs or TFSAs or RESPs or a million other things rather than paying down super low interest debt. And as a matter of fact, for my own personal mortgage, what I did was I paid off my personal mortgage, and then I kind of went right back to square one and took out a huge mortgage. And, now that mortgage is fully tax deductible because I'm using that money to invest. And again, speak with your accountant so that, there's a clear paper trail and it's done the right way. But right now, my mortgage is tax deductible, and I'm using it to invest money. And my cost of borrowing is like under 1.7%.
Yeah, some interesting points there, which I think are totally appropriate given this low interest rate environment that we're living in. I mean, there's always a bit of a debate. People wonder, do I prioritize paying down the mortgage, or do I focus on investing through different avenues that are going to generate a higher percentage return, most likely? I think most people probably fall into the latter camp. Although there's always an argument for paying down your debt, paying down your mortgage, especially if it's a hefty one. But, anyways, moving on, I want to just gear this next question to professionals or anyone with reasonable income, good cash flow. And let's say this individual is embarking on a new mortgage. What advice do you give this person if they expect to be liquid in the next 3 to 5 years in order to optimize the mortgage? Do you tell them to focus on one that optimizes prepayments? Do they consider an open mortgage, which I know we haven't really talked about today, or any other features? Like, what do you tell this individual?
So first of all, open mortgages are generally like 3 to 6%. So that's more of a very short-term thing. The practical way to achieve an open mortgage is more through a home equity line of credit or a HELOC.
Okay.
And again, I think to me it matters on who the people are, what their goals are, what their risk tolerance is, what they're saving up for. Are they planning on buying a cottage? Are they planning on buying, an investment property, a commercial property? There are some mortgages that, let's say you make a $50,000 prepayment, it will open up that available credit on your connected HELOC.
Oh, interesting.
That in 6 to 12 months, if you need that 50,000 again, you could pull it back out. And that can be a very attractive feature.
I'm really glad you mentioned that because these HELOCs or these home equity lines of credits, they're becoming a lot more popular. And it's just really important to know how they work. Not all are the same. There are different variations. So that's very helpful information. So, Elon, before we wrap this thing up, I want to make sure I give you a chance to talk to us about the latest in mortgage rules and the stress test because this information is often in flux. So, what's the latest update you can give us?
I mean, there's a lot of things going on. The biggest trend, and we kind of started off with this, is just sheer volume. So many lenders are extremely behind. They cannot accommodate fast closings. That's the first thing. The next thing is, when we think back about 12 years ago to the financial crisis, and then that created, almost a 12-year path of increased regulation, increased scrutiny. So the reality is that there are a lot of questions about documents. There are a lot of questions, appraisals, income. If you're incorporated, they really want to know how you make money. Is your income source secure? Where's the down payment coming from? Is it all in Canada? Is it coming from another country? So, the first trend I mentioned was volume. The next trend I would mention is like compliance. And it really is like walking through airport security, and they're going to throw out your bottle of water, and they're going to, take away, confiscate your nail clippers. And then you're going to walk into the gift shop past security, and they're going to sell the exact same nail clippers. So there's a lot of, questions. And what I tell people is, there's the real world and the mortgage world. And as soon as you try to argue the real world to most lenders, they're not going to understand it. So, oh, I rent out my basement to my sister. Well, that's a family member. We can't use that, or it's not a legally retrofit basement apartment. Or, I worked at Facebook for 3 years, and then I decided to incorporate, and now I invoice Facebook for more money, and I don't have CPP, and I'm actually making more money. Well, the lender is going to look at that and say, oh, well, you're newly self-employed and incorporated. So things that might be obvious, my favorite example is, two scenarios. I have a teacher married to a teacher with 10% down. I have lenders fighting over those clients, but I might have someone coming in from a foreign country with 50% down, and it's actually a pretty difficult mortgage to place,
Wow.
even though they've got 50% down. So the compliance environment, volume, compliance, rates is a big one. Obviously, rates are very, very low now. The fourth thing I would say is really understanding that, these are not simple products. And, there's bridge loans, there's porting, there's lines of credit, and you really want to make sure you're working with someone who understands your needs, who understands the questions and situations that you might have, and probably the best word is anticipate, because you might not know where you might be in 3 years, but if you're putting 50% down payment and you're an entrepreneurial style person, well, you might want to refinance in 2 to 3 years, pull out equity and buy an investment property, maybe buy a family cottage, buy a commercial property for your business. And, again, going back to what we were talking about earlier, you don't want to have a $50,000 penalty because you didn't anticipate that situation and those needs.
Yeah, I think your comment about the mortgage world not really matching up with the real world is spot on. And I think that especially applies in the case of the stress test. So I just really want to know currently in this environment, what is the exact difference between the stress test now and a fixed rate that you might be getting?
Right. So that's another really good example of where the real world and the mortgage world are nowhere close to reality. So let's just say, you get a high ratio mortgage at 1.5%. The way the stress test works is it's the greater of your mortgage rate plus 2%, which would be 1.5% plus 2%, so 3.5%. The greater of that or the benchmark rate of Canada, which is 4.79%. So that mortgage is being stress tested at an interest rate of 4.79%.
Wow.
but their real rate that they're paying is 1.5%. And again, I've had clients that, have said to me, Elan, I don't understand. My monthly payment is, 1,700 a month. I'm paying 2,400 a month, 2,200 a month in rent. How am I not qualifying? And the answer is because you're not qualifying at 1.5, you're qualifying today at 4.79.
Yeah, that is really bizarre, but I guess not all that uncommon. I guess it is what it is right now. Maybe one day the stress test will change, but just moving on, and as we wrap things up, I want to highlight a scenario that is pretty common. So, with the low rates that we have right now, there are a lot of people out there who are considering breaking their current mortgage,
Hmm.
paying a penalty, and locking in a new low rate, potentially for 5 years. So,
Hmm.
I just want to take a moment. Maybe you can touch on some key considerations here for somebody who's potentially going to undergo this process because it's pretty common right now.
So I always start off thinking like more strategically and then I get into the math. So, first of all, you have $40,000 of credit card debt. You have unused RSPs, you have this, you have that. So, in other words, you actually need some liquidity. Again, if you're paying 19% on your credit cards, any good mortgage broker is going to look at your overall cost of borrowing interest. So, that's the first thing I'm going to try to assess. But let's assume that you're completely debt free. Then there's kind of two things. So, number one is what is your penalty?
Hmm.
And the IRD calculation, especially at big banks, is very opaque, very volatile, very difficult to calculate. And as a matter of fact, I literally had a client, their mortgages with RBC, and on this was last week. On Friday, their penalty was $11,000, but on Monday it was $22,000.
Oh my God.
So, like literally, one day or one business day or whatever you want to call it could have a massive, unexpected impact. So, first of all, I always want to know, or at least try to strongly anticipate what the penalty is, because if the penalty is 53,000, that makes the business case a lot harder than if it's like 9,000. So that's first. So the first thing is like the credit cards, the overall picture. Second of all is, what's your old rate and your current rate and the penalty. So if you're paying 3.29 and I can get you 1.79 and then you've got $1 million mortgage, you're going to be saving a lot of money, like almost 1.5% every year on $1 million. Like that's a lot of money.
Yep.
And then how does that compare to the penalty? But the third way, and this is sometimes the tiebreaker, is let's assume you don't have credit cards. Let's assume that you do the math, and you're kind of you're saving 30,000 with low interest, but you are paying a $30,000 penalty. Well, that's kind of a wash.
Hmm.
But let's say you have a year and a half to 2 years left in your mortgage.
Hmm.
My concern or my comment is, in 2 years from now, when you renew your $1 million mortgage, if the rates are 299, 399, you're going to be renewing in 2 years for 399. Whereas if we do this refinance today, you are locking in for another 3 years of financial stability and the fixed rate.
Right.
So again, the math might be neutral, but you're getting an extra 3 years of protection at historically low rates, and that's where the payback might make it worth it.
Hey, that's a great summary on a very common situation as we wrap things up. Elon, I just want to thank you for taking the time to be with us today. You've given us a lot of good info. I'm always learning something when I talk to you, and pleasure to have you on the show.
Oh, my pleasure. Thank you so much.
So, doing this podcast has allowed me to reflect on some of the financial decisions that we have taken as a family, some of which have been great ones, but other ones I do wish we could go back and do over again. So, that's what I want to talk about today. And to illustrate, I'm going to go back into my past. So, 2015 is when I finished my radiology residency at Queen's University in Kingston. And that was a crazy busy year, but a very joyous year. I mean, obviously exciting because I was wrapping up the largest segment of my medical training. But even more importantly, that's the year, my fifth year, when my wife and I we had our first child. And, everything changed after that. And, for those of you who had kids in residency, including in your fifth year, you know what that process is like. It's a mix of adrenaline, caffeine, crashing, and then the cycle goes on repeat. And then after residency, we went to Southern California. So I was doing a 1 year radiology fellowship in San Diego, in La Jolla. And, we decided at that time that fellowship was going to be for two reasons, and two reasons only. The first one was getting a good education, and then equally and even more importantly was the life experience. And I won't get into too many details here, but my fellowship was essentially an unpaid position in the sense that I was getting a small stipend, maybe to cover about 3 months worth of rent. We had some savings, but anyways, not ideal. And I had people tell me, like, listen, why are you going down there? Like, you're going to be burning cash, getting hit by the US exchange rate, and then you're going to be sending yourself back financially. And I said, hold on a second, like, let's just take a step back here. Like, when else are we going to get a chance to go to San Diego for a year? I mean, I can't go there now. So, looking back, I mean, I would not have changed this for anything. And I'm really glad we made the most of that year. So after San Diego, our trip around North America continues. So the first job I got was in Calgary, Alberta. And let me tell you, like, what a great place to work. I met so many talented and inspiring people there. And at the time, so when we started off, it was the three of us in a 3 bedroom, semi detached home. It wasn't the most spacious place, but it was totally fine. And then I remember one day we were sitting at the dining table, and then basically, in the blink of an eye, with the click of a mouse, open up that bank account. We saw first month's pay, signing bonus, and then all of a sudden we just felt like our lives had changed. And human nature kicks in, and we got excited. And then to make matters even more exciting, we learned right after that we're expecting our second child. So we right away decided that our 3 bedroom semi detached was not going to cut it. And granted, okay, with two kids, somebody visiting, it may have gotten a bit tight, but I do think looking back that with a concerted effort to just take care of your spending, make use of the space, we probably could have made it work. But anyways, we committed ourselves to the house hunt, quickly found a home. This was just a few months after rent, made the down payment, and then committed ourselves to a mortgage. And then that was that. So when I look back at this experience, if I could do things over again, if I had the information that I do now back then, I just don't think buying a home at that time, so early into practice, was the right decision. And this is not to knock the Calgary, Alberta housing market. It's more about that process just ties up all your money. And when I look back, 2016 was a fantastic time to invest in the markets. So the lessons I take home from this are, for me anyways, if you're going to be making a significant financial commitment, especially early in your working years, think about putting that money into the markets because then you're leaving yourself more time, more years for that money to grow. And I do think that if we did that, we would probably be better off financially today. And then the second thing is, I really think it can be beneficial. Now, to each their own, but I think it can be beneficial in your early working years to live a simple life. So, people make fun of me for never getting lattes. I mean, I only drink drip coffee, and I think this takes me back to my La Jolla days. I mean, when you're running around broke in La Jolla, all you drink is drip coffee. That's the only way you can roll down there. So that's one of my quirks, I guess. Sports cars have just never done it for me. Again, to each their own. And then I think rent. Rent can be a great thing, whether it's for a year, 2 or 3 years. I mean, I have colleagues who are much older than me and they have never owned a home. They always rent. And again, there is nothing wrong with that. If you like what you're hearing, please feel free to download, subscribe, and spread the word. Until next time, when we talk about investing, stay safe, everyone, and stay savvy.